Good evening. I think we'll get started here. Welcome. My name is Paul Rimmereid. I'm the Vice President here and CFO at the bank. So up here we have the ledger of the bank, and if you were here for Toby's talk, you can ignore what he said. This is the ledger of the bank. Just kidding. I was going to use a joke and say it's the ledger of the bank and then kind of pause and then say from 1914, but so if you'd like to look at this after, it's the first ledger when the bank was opened in 1914. It goes into early 1915. I'm glad to say that we've progressed a little bit from this. We do have a little more robust accounting system than we have today. So I'm going to go through some information about our financials, our financial statements. I will take questions throughout, so I'll ask at a certain point if there are any questions. We are recording this. And just for everyone in the room, we're going to ask you to raise your hand. We've got mics on each side, so at points when I ask for questions, just if you've got any, go ahead and raise your hand. I will save some time at the end for questions too, so we can go about it either way. So every Fed talk has a disclaimer, and so we always start with our disclaimer, which basically says any views expressed tonight are mine and not the Federal Reserve's. I should point out, though, mostly what I'm going to be talking about is factual history, things that have actually happened, so there's not a lot of views here, so if anyone else were given this talk, they'd have the same information. A little bit on our agenda. I'll go a little bit more in depth on how the Fed is audited and at the various levels. I'll talk about the availability of financial information from the Fed. We'll cover some asset trends over the last 5 or 6 years, which is really important to kind of understand how our financial statements have changed. And then we'll get into the statement of condition or balance sheet and the statement of income. Okay, does the Fed get audited? Of course it does. This little image here is off the Board of Governors website in Washington, D.C. I've got the web link at the bottom there. So the information I'm going to share tonight is you can also go out there and actually see more information on this. So audits of the Federal Reserve. So we're audited at a number of different levels. So every reserve bank and the Board of Governors is audited by an outside independent accounting firm. In fact, just last Friday, the Fed released its 2013 financial statements, which we'll look at here in a little bit. So currently that auditor is Deloitte & Touche, a national accounting firm. So the balance sheet, the income statements, the transactions that make up those statements are audited by this independent accounting firm. And that's been happening for quite a while. It's not a recent activity or event. The Government Accounting Office also audits the Fed and the Board of Governors. A lot of times it's prompted by questions or requests from Congress that they conduct certain types of audits of the Fed. And that information is also, all this information and more is available at that web link on the previous page. The Board of Governors themselves have an Office of Inspector General that coordinates their external audit and also performs audits of the different areas of the Board of Governors. And then here at the Fed, the reserve banks, we have an internal audit function that audits the entire bank in different areas in different ways. And if that's not enough, so at the reserve bank level, we have independent external auditors, we have the Government Accounting Office, we have our own internal audit function, and then the Board of Governors examines the 12 reserve banks. So we have many layers of audit examination here. So let's stop at that point and see if there are any questions on auditing the Fed, because as Toby mentioned earlier, there have been some questions out there, does the Fed really get audited? And just wanted to kind of make sure everyone's clear on the auditing of the Fed.
Do you have different firms audit each of the Feds?
Could you repeat the question?
Different firm audit each different Fed?
It's the same firm, Deloitte & Touche. So the contract with the Fed is held by the Board of Governors, and so all reserve banks are audited by the same firm. Part of the reason that's done is one of these statements that's produced is the combined financial statement for all 12 reserve banks. So I'll show you in a little bit where there's a link actually where you can see the financial statements of each of the banks plus a combined for all 12 banks. And Deloitte also audits the Board of Governors. So it's the same firm that crosses the entire spectrum of Federal Reserve activity.
Is Deloitte the only firm you used, or do you go out and get other firms?
So periodically we bid out the contract. Prior to Deloitte & Touche, they've been on, I believe it's their 6th year on a 7-year contract. So actually we'll be bidding it out next year, starting with for the 2015 audit. Prior to that, Pricewaterhouse was our auditor. So roughly every 6 or 7 years, we rebid the contract. So the outcome of the next contract may change the auditor, may not, depending on the bid submitted.
Has any of the feds ever failed an audit?
Can you repeat the question?
Failed an audit?
No. So all the audits are clean opinions or unqualified opinions in accounting terms. So there's never been, at least from the external auditors, they've always been clean opinions. Or there are times with internal audits sometimes where there might be issues, but those are typically also minor. Other questions on auditing? Okay, if you think of any during the talk, we can certainly come back to those at the end. So availability of financial information. So first we have the bank's website, which is the top part here. So if you go to our bank website, and right in the middle, front and center is a spotlight section. And right at the top, the second item right now, and this could move, is a link to the financial statements we just released on Friday. There's actually two links though. The first link is the press release on the back of the handout, and the second release is the entire set of financial statements, including footnotes. So that's for this bank. And then the second part here, so at the Board of Governors, we've got a number of pieces of financial information that's available. On a weekly basis, they publish every Thursday a set of financial information that includes the balance sheets of all 12 reserve banks. And sometimes if you read the financial press, either on Thursday or maybe Friday, they'll say something like, Fed assets increased by X or Y. The press is getting it from this release here. So, and this information is available public through this web link. So we've got weekly financial information available here. The second point here then is all the Reserve Bank's financial statements are out there, including the combined I mentioned earlier. And they're out there back to 2008. So it's not just 2013 now, there's a number of years of financial statements out there. So if you have nothing else to do and like reading footnotes, you certainly have a lot of resources here. And then there are also some charts and graphs at this last link I've provided up here. You can actually pick certain asset accounts and graph them back to 2007. I'm going to show you a graph in a little bit, but you can kind of pick accounts and kind of see those trends for any account out there. So there's quite a bit of information available public. And this is just these are kind of what I'd call the highlights. There's other information out there also on that website in that area there. Let me stop there and see if there are any questions.
As far as the Federal Reserve goes, your member banks, has the delinquencies stopped there? I mean, do you see, is that the ones that have been closing or merging with others? Do you see a trend there where that's now stopped?
Yeah, so in general, first of all, it's probably not an area I'm not qualified to comment on. We have a regulation function in the bank, a supervision regulation, but it has declined some. I don't know if you have any comments on that, Toby?
Senior Vice President Ron Feldman is the head of our supervision and regulation area, and he presented a while back on that, but there's been long-term trends that community banks have been merging, and there's been fewer and fewer of them from a long time perspective. And I think in Minnesota, we lost about 17 community banks last year. So there has been consolidation, long-term trend of consolidation in the banking industry, but that really doesn't affect the ownership of the Federal Reserve.
Just a comment on that. So Toby mentioned Ron Feldman, the Senior Vice President responsible for supervision. He puts out a quarterly update of banking conditions on our website. So if you go out to minneapolisfed.org, you can get a real sense of the overall condition of 9th District banking institutions. So that's a good place to check.
Are all audits of the Fed performed under the same standards of any other bank, such as generally accepted accounting standards?
Perfect lead-in question. Accounting policy at the Fed. So for most transactions, certainly those that are private sector-like, and most transactions unique to the Fed as a central bank, we do follow generally accepted accounting principles. We do differ from GAAP in a couple areas. When GAAP was developed, it was developed generally for profit-orientated private sector organizations, not for central banks and their kind of unique responsibilities. So for a couple areas, we deviate from GAAP. The primary one is the first item here. Our securities that we hold, and I'll go into those, what comprises those in a little bit. We report those at amortized cost, or what we paid for them, basically, as opposed to fair value, where GAAP would say they should be reported at fair value. We report at amortized costs. The main reason being, with monetary policy and the function of the Fed, what really matters is the cost. We're not a profit maximizing institution. For us, the question is, what's best for the economy? And that drives our monetary policy actions. It's not where can we make the most profit, or how can we maximize shareholder value. So but we do disclose the fair value in the footnotes. At the end of this year, the fair value was about 1% less than the amortized cost, so it's fairly close. So that's the biggest deviation from GAAP. The other deviation is for those securities that we buy, GAAP would say we should record it on the date of the transaction. We record it on the date of the settlement, which is typically a couple days later. The reason for that is that's when the impact of the happens, because that's when we'll credit the accounts of the people or the institutions we bought the securities from. That's when reserves are kind of put into the economy. So really for a central bank, those approaches to accounting better align with the responsibilities of the Federal Reserve. So those are the two areas we really deviate from GAAP. We also deviate from GAAP that we don't produce a statement of cash flows as GAAP would require. You'll see in a little bit our balance sheet, and cash is kind of a unique entity, first of all, but cash flow to a central bank really is not as important from an accounting perspective as it would be for a private sector firm. The opinion we get from Deloitte, so typically when they give an opinion on the financial statements, it would obviously be a GAAP-based opinion. In our case, they give it it's kind of a Fed Reserve opinion. It's against our financial accounting manual, which is also available on the board's website. But they basically say our financial statements are consistent with the financial accounting manual. And in our footnotes, we explain that these are the areas we deviate from GAAP. So the majority of our accounting is GAAP-based. For these areas here, we deviate from GAAP. Now, there's some big balances in these securities. It's well over 90% of our assets, so it is a significant part of our balance sheet. But as I noted, at least currently, the GAAP fair value difference is quite small. Any other questions on this accounting policy?
When people refer to the balance sheet, what are they actually referring to? Just the assets, or?
Well, I would refer to both the assets and the liabilities. So I'll show you our balance sheet or statement of condition in a couple slides. And to me, balance, assets have to balance to liabilities and capital. So some people may be looking at the entire balance sheet, some may be just looking at a component of it. Some important concepts about the Federal Reserve that really affects our financial statements. I've indicated that these securities that we hold, we refer to them as our system open market account. They comprise over 98% of the assets. And that's not just for this bank, this is system-wide. So the monetary policy actions dominate at least the asset side of our balance sheet, and really the income statement, because this is what generates most if not all of our revenue. So the Fed has a number of roles, and our financial statements reflect those, but monetary policy dominates that. So other roles of the Fed would be we're the bank for the Treasury. So we'll see a little bit of how that shows up in our financial statements. We are a supervisor and a regulator, which really, other than the expenses of that operation, does not have much impact on our financial statements. We provide services for the Treasury and to financial institutions, which has a little bit of an impact. But by and large, monetary policy really dominates our financial statements. And once again, the question in monetary policy is what's best for the economy, and how can we make money or profit? The direction for monetary policy comes from the Federal Open Market Committee, which meets periodically. It's made up of the 12 presidents of the reserve banks and the governors in Washington. They just met earlier this week. They will provide direction for monetary policy that's carried out by a group in New York at the New York Fed. So they will conduct the operations, whatever those may be. On a daily basis, that information, transactions related to that, are shared with or allocated to all the reserve banks. So on a daily basis, if there's any changes in the security balances or there's interest income, that is shared with all the reserve banks. So even though this is handled out of New York, it's allocated to all the banks. It's the key component in all the banks' financial statements. Now it's allocated out of New York, although because of the way the allocation formula is calculated, they keep over 50% of this. It's driven by a number of other items on our balance sheet, so they keep over 50%. The rest of the other reserve banks share the other 11, or excuse me, the other 11 share the rest of it. In our case, we get a relatively small piece, about 1%. If your other banks get 2%, it's really driven by things like Federal Reserve notes outstanding and other categories. So, but this, even though we get 1%, it still dominates our balance sheet and income statement. It's over 98% again.
Well, you comment on that you focus on what's best for the economy, but economic policy is I would say governed or influenced at least by also the Congress and President. I just wonder if you would comment on that balancing of roles, and whether the inaction by Congress stimulates greater action by the Fed.
I have an opinion on that, but I'll let Toby, as our economic expert, handle that one.
So the government has fiscal policy, which is government taxes and spending, which influences the economy. The Federal Reserve, as a central bank, has monetary policy, which means that monetary policy can influence the economy. And with monetary policy, Congress has designated us with a dual mandate to have low and stable prices and full employment. So we have basically one blunt instrument, and that's monetary policy, to do that with.
Capital for the reserve banks, very different than, at least in quantity, and how it's used is different here. So our capital is based on our member banks. So we have banks that are members of the Fed. All national banks are member, and state chartered banks that choose to be members are members in the Fed. One thing that comes with that is 3% of their capital and surplus must be used to purchase Federal Reserve capital stock. And so that's what makes up our balance there. We actually retain an amount equal to that as surplus, so that makes up our capital and surplus. So it's driven by membership in the Fed, not to meet funding or financing needs. We do pay a nice 6% dividend on that. That's set by the Federal Reserve Act, as is the 3% requirement. We also have the option to call another 3%, so we could hold up to 6%. That has never happened to my knowledge. So capital is very unique, and when I get to the actual balance sheet, you kind of see how that balance compares to some of the other assets. And then on a weekly basis, we send money back to the Treasury. The Federal Reserve Act stipulates that the Fed is to use the earnings from these assets that they hold, these securities, to cover their expenses, their operating expenses, to pay the dividends to their stockholders, the 6% dividend, and if they need to use any to adjust their surplus equal to their capital. Any excess is returned to the U.S. Treasury, and we'll show you the numbers there in a second. So, time for a picture. So this is Federal Reserve System assets from the end of 2007 through the end of 2013. And this is an important picture to understand because it shows at least how the assets on our balance sheet and system-wide have changed over the last few years. As I mentioned, over 98% of the assets are made up of monetary policy-related assets, and they're allocated to all our reserve banks. So the trends on this chart, even though they're system assets, are really trends on every reserve bank's balance sheet. So if we go back to end of 2007, total system assets were just under $1 trillion. And you can see here from this bottom color, they're mainly U.S. Treasury securities and primarily shorter term maturities, 3 years or less. If I'd drawn that chart back to 1914, it would be a pretty stable line with just a moderate growth all the way back except for around World War II. There would have been a blip there related to some activities at World War II. So when we get into 2008 and the financial crisis starts unfolding, you can see that the Federal Reserve assets grew quite rapidly. So the first thing that happened in late 2008, where you see a lot of different colors, that happened after Lehman Brothers went bankrupt and the AIG issue. There was some flow of funds pretty much stopped down. There were some liquidity issues. So the Fed opened a number of lending facilities, and also their discount lending window increased quite a bit. So that's kind of what that happened there. Now, those facilities and that lending stays on the Reserve Bank that did the lending or ran the facility. So every bank has a discount window, and their lending activity probably increased from that. But these special facilities that make up a lot of the different colors in there were primarily operated by the New York Fed. So they would have stayed on their balance sheets. So we kind of get through that crisis, and you can see a lot of those colors go away. And then we've got growth here in this category, which is U.S. Treasury securities. And then a new category comes in, which is mortgage-backed securities. So that's what's known as quantitative easing phase 1. So we've actually done 3 of those. So phase 1 was right in here, phase 2 right here, and we're actually still in phase 3. So those were enacted obviously at 3 different times, primarily to put pressure on longer-term rates. That's why and to help housing markets. That's why the purchase of the mortgage-backed securities. So we're still in quantitative easing 3. The FOMC just decided this week to continue tapering the purchases. So we're still purchasing, but at a slower rate. So this graph will continue to grow, at least for the near term, but the rate of growth will not be as it has been. So at the end of 2013, we're over $4 trillion in assets system-wide. So this is kind of helps explain kind of how the balance sheets of the Federal Reserve System have changed over the last few years. Any questions on this chart?
Since as of the most recent numbers, the really seems to consist of 3 categories. One of the significant ones there is other assets and programs. Could you comment a little bit on what that would represent?
It's a lot of little things is what it is. So that other asset category, it's been around for a long time. Even if you go back here, the top, the size of that band hasn't really changed that much since back there. So other assets would be the facilities here, this bank, all the buildings and equipments in the Federal Reserve System. We have some things that are pretty esoteric called gold certificates and special drawing right certificates. So it's a lot of categories, but they really haven't changed that much over this period. But you're right. So right now, our balance sheet's though is dominated by mortgage-backed securities and U.S. Treasury securities. I show you the asset side here. So when we go out each month, and we're down to $55 billion in purchases each month now. So that's the asset side of the equation. So we're buying these securities. The liability side is we're crediting institutions' accounts we're buying this from. So our liabilities are growing in what we call our deposit account. So that's injecting additional reserves into the banking system. So we got assets going up, mainly in mortgage backs and treasury securities. The offset is reserves deposited in the accounts of financial institutions. Question back there.
Does the Fed, or do you anticipate that graph going the other direction ever? That seems a significant 4-fold increase in a 6-year period when you said that for the previous 100 years it had been not increasing at nearly that rate.
That's the $1 million question. There's a lot of views out there on what should happen going forward. As the financial officer of the bank, I think I'll pass on that. I don't know if Toby's got any comments you want to make on where that graph might go.
Like Paul said, most of those assets are monetary policy related assets, and the Federal Open Market Committee decides what to do with monetary policy. So they would be the ones deciding whether to shrink the asset base or grow into the asset base.
As you've been buying more agency mortgage-backed securities, I assume that Freddie Mac and Fannie Mae are the two major issuers of that debt. Whether it's intentional or not, aren't you assisting the administration because now that both of those agencies are bankrupt and have been folded in to the Treasury, if they were to recognize the losses, which are enormous on that portfolio, that would increase the reported national debt? My second question is, the theory, at least when one reads the newspapers, of purchasing these assets from the private sector and pumping money into the economy is that the private banks will then lend it and stimulate business development. And as we all know, that hasn't happened. Many of the banks are just reinvesting it in other federal instruments, taking no risks, and unemployment has muttered its way down. But so after 4 years, the theory of stimulating the economy through your purchases clearly isn't working. Is there any reason why you'd ever change what you're doing?
Let me just make a brief comment there, and Toby can kick in. So, it's really not my place to comment on actions of the Federal Open Market Committee. We do buy the mortgage-backed securities not directly from those agencies. We buy them from these financial institutions. So we're buying them on the secondary market. Whether it's been effective or not, that's for the Federal Open Market Committee to make their determinations.
So in terms of the agency mortgage-backed securities, Fannie Mae and Freddie Mac, those agencies guarantee the payments to anybody that buys their securities. The Federal Reserve bought a lot of their securities. So in essence, Fannie Mae and Freddie Mac are guaranteeing that they're going to pay us. And if they will pay us, and if they experience a lot of losses in the mortgages that they purchased, they would have to eat the losses, and the losses would still be shown through accounting on their side. What's been happening over the last couple of years is that they've been purchasing mortgages that are very sound with a lot higher cash levels, a lot higher credit scores, et cetera. So from an accounting perspective, they've been actually making money recently. So the losses that they did incur before were from the mortgages that weren't being paid back that were issued during the boom. The second question was related to
lending out the.
Oh, so then Paul's going to talk more about the other side, which is what are the banks doing with all the money that they're getting? So normally when a bank gets money in deposits, when you deposit money into your bank account, they're required to hold on to a portion of that. There's a reserve requirement. They're required to hold on to a portion of that. And usually what they do is hold on to that portion and lend out the rest. Because when they lend it out, they get a lot higher interest rate. What Paul's going to explain in a little bit is that a lot of the banks take that extra money and they hold on to the required reserves, but they've been giving it back to the Federal Reserve in the form of excess reserves. So as our balance sheet has increased a lot, our liabilities have increased a lot, and those liabilities are primarily in the form of what we owe to the banks from the banks giving us back the money.
What are or could you explain what the ramifications timing-wise if you were to reduce, and I think it was somewhat of a question that was asked before, if you're able to reduce those assets as kind of a goal of the Fed, what are the ramifications of the economy?
So if we reduced, I guess it depends how you reduce and the timing. It's an economic question. I mean, there's an economic question. There could be a financial impact. So if we were to reduce, we'd have to sell assets because unless we wanted to reduce really slowly and let these mature and fall off, so we'd have to sell assets. When we're selling assets, that means funds are coming into the Fed and coming out of the economy, so that's a form of tightening. And most economists would say now's not the time to tighten.
So what you're saying is that with the banks giving out the extra reserves back to the government, or back to the Fed, they're in effect reducing the money supply?
They're reducing the potential money supply. When we push money out, banks, through the fractional banking system, magnify that. It's through the deposit multiplier that money is then created in addition to the money that we create. So normally what happens is we crank out $1, and let's say the reserve requirement is 10%. $10 is created through the fractional banking system in a bunch of loans. Now what happens is we crank out $1 trillion, $2 trillion, $2.5 trillion, and the banks take that money and give it back to us. And when Paul shows the liability side, you'll see that in the form of reserves, especially excess reserves.
Question about Freddie and Fannie, and contradicting the gentleman back here. In the news recently, they're doing so well, returning so much money back to the Treasury, that the discussion is about privatizing them again, rather than having them be under federal influence. I may be wrong about that, but that's what I've been following. I'm not an expert on it. And the concern I think in the marketplace is because the Fed assets have quadrupled into $4 trillion out of a, say, $17 trillion economy. Is it too big?
Yeah, we own a greater percentage of these assets that are outstanding than we used to, and that's clearly true. Here's our balance sheet or statement of condition that was published last Friday. That's out on our website. This is pretty detailed and hard to see, so I can certainly take any questions on this, but what I've done on the next slide is summarized it to kind of hit some key accounts so we can focus on those, but I certainly will talk about anything on our balance sheet here. So at the end of 2013, we had assets of over $38 billion, and obviously liabilities and capital of also the same amount, $38 billion. Let me go to the second line there first. So U.S. Treasury and other securities, $37.5 billion. That's what we've been talking about. Those are the treasuries and the mortgage-backed securities that make up over 98% of our assets. And that trend is true on all reserve banks. Even pre-crisis, when system assets were under $1 trillion, it was still by far over 90% of the balance sheet. So it's always been the key component of the balance sheet. The numbers are bigger now and the percentage is even a little higher. Let me talk a little bit about coin here and Federal Reserve notes. Touched on this a little bit earlier. So when I was a young accounting student, one of the first things I learned was cash is an asset, and that's a good thing. So when I started at the Fed, I looked at their balance sheet, and I saw coin as an asset, but then I saw Federal Reserve notes are currency as a liability. There got to be a mistake here, right? This cash is an asset. Well, if you think about it, so currency is called Federal Reserve notes, and if you look on a note, there's samples back there. I don't know if anyone picked up the samples. They're a little hard to read, but if you look at a Federal Reserve note, and if I can get I happen to have a nice $10 bill here. First thing, it's got a I-9 on it, which I stands for this district. That's the 9th letter of the alphabet. 9 is for this district too. So this is a 9th District Federal Reserve note. So we're the ones issuing the note, so we're standing behind it. So we are liable for this. So the Federal Reserve Act gave the Fed the power, the responsibility to issue Federal Reserve notes. So that's why it's a liability in our books. We're issuing it, whoever we're issuing it to, they're recognizing an asset, but we're on the other side of that transaction. So it's a liability in our balance sheet. So the balance in that account is the number of I-9 notes that are in circulation, that have been issued, and we reduce that by any currency we hold in our vaults here. Now on the flip side, coin, you can look at a coin and it will never say Federal Reserve coin. It'll say something like U.S. Treasury or U.S. government. So the U.S. government or Treasury mints at the U.S. Mint produces the coins. We distribute them for them, so we in essence buy them from them, and then we issue them or sell them to financial institutions to meet their needs, as we do with currency. So the coin on our books as an asset of $48 million is just our inventory of coin we have here to meet the needs of financial institutions. Whereas the Federal Reserve notes is our liability of notes that have been issued less any we hold on the vault here. Now you'll notice that for the Federal Reserve notes, they actually changed quite a bit from 2012 to 2013. Went from 19 billion to 12 billion. So what happened there? There wasn't really a change in the number of I-9 notes issued. I mean, we do destroy the old and worn out ones, but we issue new ones all the time too. But our inventory increased quite a bit towards the end of 2013 and actually into early 2014. And what that was for is the new $100 bill was issued late last year. And so we built up our inventory, and we built it up not just of new $100 bills, but as a contingency, we also built up old $100 bills in case there were issues. So our inventory went up quite a bit. And so when we do this calculation on our balance sheet, it's what's been issued, less what's in the vault, and that's why you have the big change year over year. That change will go away in the future because we're reducing that inventory of hundreds now that the new 100 has been successfully released into the public. So the Fed's balance sheet obviously is very unique on how we handle currency accounting. You can see the third line up there, foreign assets and swap. So we do own a small amount, and this is another one of those allocated accounts. We do own a small amount, mainly euros, of euro currency related instruments and some bonds, but it's a very small amount. And those are really held in case they need to intervene in currency markets, which they almost never have done. So it's really a pretty inactive account. There are swaps that are in that account, which were used actually earlier in the financial crisis, where there was such demand in Europe for U.S. currency that the European Central Bank and others drew on swap arrangements we had with them. So we, in essence, lent them U.S. dollars for a fee. And a lot of those have been closed out now, so the balance is much lower than it used to be. We have an account up there called the Interdistrict Settlement Account, which is really an account between the reserve banks. It's like an intercompany account, if you're familiar with that. So if we combine all 12 reserve banks, that account doesn't exist because it zeroes out at the system level. But there's a lot of transaction between the 12 reserve banks on a daily basis. One of them is the allocation of the daily system open market account. There are a lot of transactions related to member financial institutions, whether they're doing ACH transactions with us or funds transfer transactions. You can see that balance can change because at the end of 2012 it was an asset. At the end of 2013 it was a liability. That account kind of moves around quite a bit depending on the nature of the transfers between reserve banks. Looking at the liability side beyond Federal Reserve notes, so here we have depository institution deposits. This is where we hold required reserves and excess reserves. Pre-crisis, that number was like very small. When I say very small, it would be, so here we have 7 billion. It was maybe in the $40, $50 million range. Banks just held the required reserves and that was it. A couple things account for the increase. One, we pay interest on reserves now, which started in 2008. So currently we're paying 25 basis points or 0.25% as interest on both required reserves and excess reserves. If we looked at this number system-wide, right here, it's about $2.5 trillion. And most of that is excess reserves. So that gets back to the discussion earlier. The initial accounting entry when we're selling these securities is to increase the asset, and the offset is to that account as excess reserves. And then the question is, what happens with those excess reserves? Do they stay at the Fed? We have $2.5 trillion, so that seems to be the case. Or there's a lot of movement of it, but some of it still may end up back at the Fed. If you buy, so if one company is going to build a building, they go get a loan, that bank may take their money out of the Fed account, give it to who's going to build the building. They may deposit it in their account, and that bank may put it in the Fed. So in some cases, it's hard to make strong conclusions from the balance in reserves here because a lot of it depends on the movement of those accounts. But this is where it would show up. So this is, on our balance sheet, it's not as great as if you looked at the system level. Like I said, system-wide, it's $2.5 trillion right now. System-wide, the balance sheet, obviously the assets are $4 trillion. $2.5 trillion is in mainly excess reserves with also reserves. A little over $1 trillion more is in Federal Reserve notes outstanding. Those are the key components of the system balance sheet. We also have something here called securities sold under agreements to repurchase. You can see we went from just under $1 billion to almost $3 billion at the end of last year. That's a monetary policy tool. They've actually been testing that. In the press, it's known as reverse repurchase agreements. It's a way to tighten. And so they've been testing it now. They actually had a big test over year end. And so that balance actually has dropped down some now. But there's a question earlier, do you sell assets? Other ways to kind of tighten without selling assets are to utilize more of this instrument, or we have other ways we have what we call term deposits too, which are another way to try to hold reserves within the Federal Reserve System. So I'm venturing very close into monetary policy here, so I'll try to pull it back into our balance sheet here. Any questions on the statement of condition at this point?
You mentioned the 0.25% paid on required and excess reserves. Now, that wasn't always the case. Is that planning to be changed? Is that going to continue? And wouldn't that be a disincentive to lending?
So it's been in place since 2008. It's something the Federal Reserve is wanted to have for a while. It took an act of Congress to pass. When it actually passed, it was initially scheduled to be implemented in 2011. But when the crisis erupted, Congress actually changed the implementation date to 2008. So it's only been around since 2008. So prior to that, that's why banks minimized what they held with us, because there was no earnings on it at all. Is it a disincentive or not? That's a great question. That's debated by a lot of people. So the question is, why don't we reduce, particularly the excess piece, to a lower or zero? That's another one of those decisions where the Federal Open Market Committee has looked at that and determined, at least for now, that they're going to leave it where it is. They haven't signaled anything change-wise, but that's certainly one of the things that they evaluate on an ongoing basis.
If the federal government were to default, what would you see happen to your balance sheet? Would there be any impact on this?
If the government were to default, well, we do own a lot of U.S. Treasury securities, and we own a lot of mortgage-backed securities. So, but it's obviously a theoretical question. We do have the power, and maybe this is a good question for the next session here on the Federal Reserve Act, but we could go out and buy different assets. We have the power as a federal bank. We influence the money supply. So maybe instead of maybe we'd start buying cars or something, or I'm not sure what would happen there, but it would certainly be an interesting scenario. Toby, any thoughts on that one? Get that question before?
The assets we hold, the securities we hold, are at face value, right? Or what we purchased them for.
Yep.
The market value of those assets would probably drop if the government started defaulting and not paying the interest on the debt. The market value of those securities would probably drop. So in our footnotes, we would say, well, the fair value went down. Our book value still on our balance sheet is still the same, but our fair value went down from an accounting perspective.
And we would stop getting interest, so our earnings would potentially go. It depends how long they defaulted for one, too. So,
I've got two questions. First, earlier you said that the holdings of Treasury securities were pretty short duration, around 3 years or so. How would you characterize the duration of the balance sheet today?
So today they're much longer maturity. Actually, in our footnotes, I believe it's footnote 5, if you want to do some reading. So historically, they've been 3 years. Pre-crisis, pre-2007, they were 3 years and less usually, very short term. They've moved into, in fact, right now there's hardly any that are 3 years and less. So one of the actions that really didn't change the balances was called Operation Twist. And actually, I'll show it on the income statement a little bit. And that was mainly in 2011, 2012. To put downward pressure on long-term rates, they sold all the short-term Treasury securities that had a maturity of 3 years or less and invested in securities with a maturity of 6 years or greater. And so the holdings right now is probably the duration is much longer. I don't have the exact number, but it's gone from something very short to 7 to 10 years probably. So there's much longer term securities in our portfolio right now.
And the other thing is I'm trying to get my head around the accounting for example, when you built up that currency inventory, what would be the other accounts that are involved if you're going to sort of increase that contra liability account? What's the other side to it?
So probably the buildup of the inventory depends how we're getting the inventory. So if we're getting it from financial institutions, let's say, financial institutions deposit funds with us on a daily basis. So that goes into our currency inventory. So when they deposit with us, it builds up our inventory, which is a contra liability, and the opposite is to their DI account, their account with us. So it affects that. So, but the new issue of currency would probably come to us through this interdistrict settlement account, because the Bureau of Engraving prints the currency for the Fed, and then they issue to various reserve banks, so it would come to the Fed through that account.
The economy changed dramatically in terms of company hiring, and with the minimum wage increase up to is on battle on the Capitol, and it affects the companies in the way they hire and people being employed in this day and age. How do that affect the Federal Reserve in that terms? The the minimum wage and the company want to borrow and all that.
As far as our financial statements go, it really hasn't had an impact. I don't know, Toby, if you have any policy comments on that one, or?
It's outside the realm of the Federal Reserve, and we could probably spend an hour or two talking about it. So it's probably not pertinent to this discussion today, but maybe afterwards we can have a conversation about it.
I'm looking at a more detailed balance sheet than the one on the screen, but you sent it out with the enrollment email documents. In that 37 billion figure, 14.5 billion is federal agency and government-sponsored enterprise mortgage-backed securities. And that 14 billion is up about 77% from December 31st of the prior year, 2012. Now, we all know that a balance sheet is a photograph in time, and the income statement is a moving picture of a whole 12 months. But the income from that class of assets is virtually flat in the calendar years 2013 versus 2012. Roughly 365 million. So I don't know whether you juiced up the assets very close to the end of the year, whether that 77% increase on December 31st came in the last month of 2013. But the implication is if it didn't, if your asset levels increased by 77% throughout, early on in 2013, that your yield on that class of assets has dropped substantially. Could you tell us what is happening there?
I'd be glad to. So two things. Remember this picture here. So we got the second category, mortgage-backed securities. So for 2013, that category is growing, and you can see it's growing at a constant rate. So this is the quantitative easing 3. So our mortgage-backed securities grew at a fairly constant rate. They're buying system-wide between treasuries and mortgage-backed securities about $85 billion every month, roughly split, almost 50-50 between U.S. treasuries and mortgage-backed securities. That's the system-wide picture. And that was our picture at this bank in 2013. What happened in 2012, which affects the year-over-year comparison, as I said earlier, we get roughly 1% of these assets, and that percentage is adjusted in April of every year. So in 2012, for the first 4 months of the year, our percentage was actually 1.5%. So we were getting a bigger share of those assets and a bigger share of the income. That's the key point here. So the base year in that comparison, 2012, has things going on where we were getting a greater percentage earlier in the year and a greater percentage of the income. And so that affects the year-over-year comparison. At the system level, you don't have the anomaly you're seeing in the Minneapolis bank. We had those assets grew at this level, and the incomes grew at that level. It's just a change in allocation early in 2012 that affects the Minneapolis view there. Okay, so here's the detailed statement of income once again, which is a little detailed, but we'll certainly take questions on it. And if we go to the more summarized view, I just answered the first question. So we have interest income that is down in 2013 versus 2012, and it's for the reason I just explained. Even though our assets have gone up quite a bit, and the interest rates weren't that much different, we had an allocation change that affected the 2012 was higher than it would have for this bank only. So year over year, at the system level, you still see the growth that kind of correlates with the growth in assets. Then we have interest expense. So this is the 25 basis points or 0.25% we pay to our depository institution that holds funds here. So if that rate is increased at some point, at some point when the economy is moving better, they'll probably raise that rate. That doesn't seem likely now, and the question was earlier, should we even reduce the rate on excess reserves? That balance would go up, we'd be paying more interest. The question is what will happen to the balances that we're paying? Well, if the economy is more robust, there may be less excess reserves held with the Fed. So it's really tough to know where that account may go. So that brings us to net interest income of $829 million. Then we have some non-interest income, and you can see a decline there in 2013 from 2012. It went from $230 million to $85 million. The difference there is 2012, I mentioned this Operation Twist program earlier, where we moved from shorter-term treasuries into longer-term treasuries by selling the shorter-term ones. We had gains on those securities. So the fair value of them was higher than the cost on our books. So when we sold them, we had gains. So the difference between the 2 years is the gains on those securities as a part of Operation Twist. Historically, the Fed has rarely sold these securities. We usually let them mature and then reinvest them. It was just early on in the crisis and then with Operation Twist where we've actually sold securities. The other things that are in that category are types of reimbursements. Some of it is from the Treasury for services we provide to them, like processing savings bonds. And the other category in that, main category in there is we provide some services for other reserve banks, mainly in this bank related to ACH, that we get reimbursed for. The next category is operating and other expenses, $201 million. Primarily, it's the cost of operating this bank, the personnel costs, facilities, equipment. System-wide, this is about $6 billion. Now, included in that is some assessments we get from to cover the Board of Governors expenses, to now pay for the Bureau of Consumer Financial Protection. If you kind of scrape those away system-wide, it's about $4 to $5 billion cost to operate the Federal Reserve banks and the Board of Governors. So that brings us to net income before profit, or net income of $713 million. It's a pretty good profit margin right there, by the way. So one of the things the Federal Reserve Act says is the Fed is to return to the Treasury all income after covering for expenses, which we've done, saving some money for dividends and equating surplus with capital. Now, this income statement is GAAP-based, so we actually have some other minor income categories down here that are called comprehensive income. And so the next step for us is to return funds to the Treasury. So when we do that calculation, we not only take what's ever in this line, we also take this line, and then we say, okay, how much do we need to hold for dividends, which is about $8 million a year. We had very little need to equate additional funds for surplus. So last year we returned to the Treasury $721 million, this bank alone. System-wide, it was about 100 times that. I'll show you that in a second. When it's all said and done, we have, because we're returning all the excess to the Treasury, we have an income of $9 million, which is $8 million for dividends, and another $1 million was to increase our surplus slightly to equate it with capital. We had a slight capital change. Before I take questions, let me just show this slide. So this is a graph of payments to the U.S. Treasury system-wide. And these payments happen weekly, but for totals for the year, so historically they've been in the $25–30 billion range. You can see that starting in 2009, they've increased dramatically. Well, when you increase your assets from $1 trillion to $4 trillion, and those assets are mainly generating interest income, the Fed has significantly more income. So we're returning significantly more dollars to the U.S. Treasury. So the U.S. Treasury, their budget is roughly $3 trillion, so we're returning about $80 billion. So it's 2 to 3% of their receipts. I should say their receipts, excuse me, because there's a difference between their budget and their receipts. So their receipts are about $3 trillion. So, and once again, this is required by the Federal Reserve Act. So all excess funds the Fed has go back to the U.S. Treasury. Questions?
I have two questions. One is just a terminology piece. When you use the term financial institution, do you really mean member banks? I have a broader definition when I think of financial institution.
So it's more than member banks, because so that deposit account I have could be non-member banks.
Okay, but it is banks.
It's financial institutions, yes. It could be a credit union.
Okay, not a brokerage though.
No.
Not okay. And the other question is, with paying the 25 basis points back to the banks, do you happen to have any idea what their spread on their other loans is these days? It would be significantly more than 25 basis points, right?
I would hope if they're lending, they were making more than 25 basis points. I do not have that information. That just,
like 200 or 300 basis points, maybe?
That's, I don't. Okay. Clearly, 25 basis points is in a normal situation is probably not a savings incentive, right? So, so summarizing, one, as hopefully you've seen, the Fed is audited in many ways, and from a financial statement perspective, we're audited by an independent auditor. They do, and as you can see from our balance sheet, it's driven by, in our income statement, it's driven by monetary policy actions. So even though maybe the monetary policy decisions aren't audited, as Toby touched on earlier, the transactions are. All the financial transactions and the balances are audited by an independent entity. Information is publicly available. You're welcome to go out and read it and peruse it all. System open market account is obviously very important. It's the key component of most of the assets and income of the reserve banks. Primary source of our income. It's how the Fed funds itself. We don't, we're an independent entity. We don't go to Congress for funding. We're set up, and because of the portfolio we hold of these securities, that's our funding source. We're self-funded in essence. That's unique to central banks. We've talked about the uniqueness of Federal Reserve notes and how they're handled versus coin on our financial statements. Just out of curiosity, what % of U.S. notes do people think are held outside the United States? Any guesses? More than half is held out. We think more than half is held outside the U.S. Some think maybe 2/3 are held outside the U.S. It's the currency of much of the world. So, capital is driven by membership. Since we're self-funding and have significant income, it's really driven by the Federal Reserve Act and the member banks versus other means. And we make payments to the U.S. Treasury, and currently and recently they've been fairly significant.
With regard to that reserve currency, there's vicious emails, fear-mongering. Is there really another country that could possibly fill those shoes, so to speak? And what would need to happen in order for that to be real?
Well, some people, I think China would like their currency to be a stronger world currency. I don't know, you have any comments on this, Toby? I don't really have any comments on the, I think the world sees the value of the US dollar and what stands behind it, and nothing has really kind of filled that void.
I think when we were on break, we had money running on the background, and money is three functions. One is medium of exchange. You can exchange it between people. One is it's a unit of account. You can measure things in it. But probably most important, it's a store of value. And that means what the value is today is pretty much what the value is going to be in the future. And what we found, or what the world knows, is that the Federal Reserve has been pretty good at making good money, meaning that the store of value is going to be there. And until another country can prove that it's going to have a long-term store of value, they're probably not going to overtake the U.S. currency as the reserve currency of the world.
I've heard some politicians call for an audit of the Fed, and I'm wondering what is it that they want that you're not.
We wonder the same thing. I think some have wanted to audit the monetary policy decisions. I'm not sure how you would audit a decision like. I mean, it's a judgment, right? So, because that's the only area that's not really subject to audit by the Fed is the decisions of the Open Market Committee. The resulting transactions are fully audited. All other operations of the Fed are audited, but. We agree with you. We agree with you. We think it's politically based. I mean, this is my view right now, so that's the disclaimer there. So. But yeah, I think that the Fed is obviously trying to be very transparent. Like I said, the audits have been going on for quite a while. It's not a new thing. Publishing the minutes has been going on for a while. The chair now has a press conference every quarter to try to explain the decisions. They testify before Congress. Not sure what they would get out of it.
So if 98% of the assets and most of the Federal Reserve income comes from the system open market accounts, that income is coming from the U.S. Treasury, right? Who's
True.
paying the income on those U.S. Treasury bonds. So the income that we're paying to the Treasury actually is Treasury income they're paying the Fed, right?
Right.
Okay.
True. Yep. Oh, some of it comes from Fannie and Freddie, and you could argue whether they're part of the U.S. Treasury, but yes, so it's interest from the U.S. government to the Fed and back to the, yep.
In the waning days of the Bush administration in the last quarter of 2008, his Treasury Secretary went to Congress and asked for $700 million, and that request was a single-spaced one sheet. Later, it was increased and then increased again, so by the end of the first quarter of 2009, the so-called TARP bailout was about $850 billion. By the end of 2009, the Federal Reserve had opened the discount window to virtually everybody, not just commercial banks, which had been the classic situation, but financial intermediaries, the brokerage houses, the investment banks. And that allowed the illusion that the banks were stabilized and they were able to repay the TARP money to the Treasury. But they repaid it with money that they were borrowing from the Fed at 0.1%, and that's the way it stayed. So now the banks don't have to use the so-called real market to borrow money. They just borrow it from you. Am I wrong? And if so, can you straighten me out here?
Well, let me say, all those loans and facilities have been paid back in full. We made money on that. Currently, there's very little lending going on. At the time, there was a lot of lending going on in this point in time, as you're right. You don't see these colors of that lending over here now. Discount window lending, which is this traditional lending in purple, hardly shows up on the graph. So there's hardly any discount window lending going on. All these other facilities are closed, pretty much. So, yeah, there was a lot of lending. It was all paid back. There was no losses. The Fed took no losses on any of their lending. It was all fully collateralized. We made money because we charged interest on it. And the TARP was totally a fiscal policy item. The Fed was not involved with the TARP. So. I'm certainly willing to stay around after if you want to talk one-on-one. I'm sure Toby would. We can talk about our accounting system from 1914. May 29th will be the next exciting one of these where Neil Willardson, who's sitting in the back, will talk about the Federal Reserve Act. So everything you want to know about why the Fed does what it does, a lot of it's driven by the Federal Reserve Act, and he will answer all your questions on that. So.
With the recent increase of use of Bitcoin, what do you think does that have effect on the U.S. currency?
Could you repeat the question?
Bitcoin. What is its effect on U.S. currency?
Zero, I would say.
So I just talked about the 3 functions of money. Easy to exchange. Well, if you're online, I guess it might be easy to exchange. Store of value. It was 2 cents a couple years ago. It was up to $1,500, down to $600. Store of value. It's very fluctuating. So I'm not sure how good of a money Bitcoin is.
The Fed does not invest in any Bitcoin right now. We're studying it. There are people here that study it just as one of our responsibilities is, is the payment system. And so we study and we're trying to understand it, but we're certainly not part of that enterprise. Well, thank you all for coming tonight. It was a great crowd, great questions. Hopefully you know a little bit more about the Fed.